And welcome to the OANDA Market Pulse Charting Analysis video. My name is Craig Erlam, Senior Market Analyst at OANDA. Now today we've seen quite a lot of volatility in the markets and some key moves, so there's a number of charts I want to touch on, so I won't be spending quite as much time on each. The first break which we've seen from something we highlighted earlier in the week is in cable. We've seen that 145.50 level come under pressure today. Now we have seen it retrace a little bit, but if we take a look down, let's say the hour chart, we can see that this is looking potentially more like consolidation. We haven't seen the prior lows broken yet around 146. This is looking like the early stages of consolidation at this stage, as opposed to bottoming out in the pair. So I would expect to see a continuation lower in cable going forward. Now what's interesting about this is that the next level down is quite a significant way below, because what we're effectively seeing now in cable is multi-year lows off the back of this break. You can see that we have to look all the way back to 2010, May 2010 for the last time we traded below these levels, and last time we were at these levels in 2010 it was quite an aggressive drop lower that we did have here. So I think the next major level really comes in at around 142, quite a significant way below here. Now of course if we drop to the daily chart, we could potentially look back towards 2010 and find some intermediate levels, potential intermediate levels of support along the way. You can see here that potentially around 143.50 could provided some support around May and June in 2010, but really the overall the next major level support here has got to be those 142 levels from a technical standpoint. So that's what we'll be looking at next, assuming of course we do get a daily close below that 145.50 support level which I've highlighted previously. Next is dollar yen, and again we've seen another break of that support zone that we had. We were talking about 118 to 118.70 previously. Again, this was a zone that was a major level of support between February and May, and then again between September and October. We have seen it break below here today, and as of yet it's continuing to trade below these levels. We actually saw it reach 117.30 at one stage, and again if we just zoom out you can see just how important a region of support that this was. Below here you're looking back towards maybe 115 to 115 towards, sorry, 115.50 to 116 for your next notable level of support. And again, this region was key in December 2014, again in January 2015, and then August this year when we did have that last period period of turmoil around China, when we did see a lot of the safe haven plays, which is effectively what we're seeing right now in the markets. We're seeing big safe haven plays coming out, which you'll see again throughout the charts we'll show you. But if we see a daily close below these 118 levels, then I think we will be looking back towards 115.50, 116. But again, 117 could be an intermediate level of support. Again, it's a round number, which is what we've highlighted on previous videos, but this was a notable level of support during the ascent from January last year. We saw in February it did pull back towards these 117 levels before climbing high, so we could see it provide some support again. WTI is the next one. Again, we are seeing a lot of weakness around in WTI this week, in line with this risk on, risk off pattern. Of course, Chinese growth fears do tend to stem fears about demand for crude, and at a time of oversupply, that tends to be bearish for WTI and Brent. Now we have seen those 32.30 levels broken, which again I've highlighted previously. We are again at multi-year lows here. We've got to go back. To February 2009 for the last time we traded at these levels. The fact that these levels have been broken today, which means we're actually trading at the lowest levels in more than a decade. We've got to go back to 2003 for the last time that we saw oil WTI crude at these levels. 31.20 is the next level of support really, but again I think this is only going to prove to be temporary. I think the next major level has to be $30 prior level of support, and also it's a big psychological technical level as well. So 31.20, you can see we've found support so far around 31.50 again, which is not entirely surprising, but I think $30 really is going to be the target now for this for oil. I think the markets are gradually heading that way, and as of yet I'm not really seeing any reason why we should suspect that it's going to ease up at all. Again, if we look at the 1 hour chart, this very much looks like consolidation as opposed to any reversal or any significant correction in the pair. you can see that this is basically just looking here now like a bit of a flag formation, at which point if we do see a break lower, we could see these 31.50s come under pressure, and then we'd be looking back towards $30 potentially in the coming days or weeks. Gold I'll touch on next, and again this is very much in line with the safe haven plays. Again, gold, well, in the last 18 months hasn't necessarily been a big beneficiary of the safe haven play that really helped supported it on many occasions over the years. The last 18 months we haven't necessarily seen it benefit from the safe haven aspect, potentially because the low inflation environment, the Fed considering raising interest rates and eventually raising interest rates. I think these have really weighed on gold and overshadowed the safe haven aspect of it, but we are very much seeing this risk on, risk off environment play at the moment, and the safe haven flows that we're seeing today is certainly benefiting gold. Now, we mentioned 1080 in recent videos. Now this has been broken, as has the 55-day simple moving average. We've seen a close above both of these, which is quite bullish. The next big obstacle right now is 1100. Now we have seen it touch 1104, 1105 pretty much today. We need to see a close above 1100. This is again prior level of support throughout September and early October. If we can see this, and again it's a big psychological level, 1100, big round number, big psychological level. If we can see these levels taken out, then I think we could potentially see a move back towards these 1130 to 1140 levels, which you'll remember were quite key on the move down. You can see that we've also had the gold has obviously been in a long-term decline. We've seen that these levels 1130 to 1140 were key in November 2014, again in March of last year. We could see these come into play again. We've also got some big fib levels along the way. Now, the first couple, we've got the 1100 level, which coincides with the 38.2% Fibonacci retracement level. Doesn't seem to be, it's holding in the short term, but we have seen it broken above, and I think we could potentially see further moves. But if we do see a move higher, 50 fib level could come into play around 1120, although it doesn't really coincide with a historically significant level. For me, it's the 61.8, which again combines with the 200-day simple moving average, which, while not being overly significant recently, in the past has been quite a significant moving average for gold. You can see during the ascent back in 2010 and onwards, gold really did just track the 200-day simple moving average higher right up until the point when it reached its highs above $1,900 in September 2011. Now we have grinded lower since, but it was really the break of that 200-day SMA that really did give us a strong signal that gold had maybe reached its peak. Now, of course, we have seen it trade around that 200-day simple moving average since, but the fact that this coincides again with the 61.8 Fibonacci retracement level from those highs on the 15th of October to the lows on the 3rd of December, the fact that it coincides again with those prior levels of support, that prior region of support, suggests to me this could be technically a very significant level. Again, a break above, we'd be looking back towards these 1190 levels where we've got previous resistance, and also potentially that long-term descending trend line, which goes back to May of 2013. Next is Euro Sterling. Again, we've seen a nice technical break here. We've talked about this long-term descending trend line previously, and we have actually seen a break above here today. So this is a long-term descending trend line which has been going on for almost 2.5 years now. We've finally seen a break above here today. People talk about the euro being maybe benefiting from the safe haven aspect, and it's something that it's difficult to get to grips with it when you consider what the euro area has gone through over the past 5 years or so. What I think this is the unwinding of the carry trade. You've got the risk on environment where you've got the high yielding currencies, the Australian dollar and so forth, where they benefit from that. But when you see the unwinding of the risk trade, the unwinding of the carry trade, that's when your low yielding currencies, your Swiss franc, your Japanese yen and the euro tend to benefit. And I think that's what we're seeing here, is the unwinding of these carry trades. Now we've seen this break through the descending trend line. This is first initial strong signal that we could be seeing a far more bullish move developing here. We've got this zone of resistance really between 74 and 75. Again, prior level of support on the way down, but in May of 2015, and again throughout September and October, and at one point in August, this zone proved to be a very strong resistance level. If we can see a break above 75 on top of the break of that descending trend line, that would suggest to me that things are looking much more bullish for this pair, and we could be looking back towards these 77.50 levels, which again during the decline were quite a significant levels of support. So something to watch out for here. We've also got the full decline here, where we've got the highs from August 2013 to the lows of July 2015, and we've got the key fib levels, which I'll be keeping an eye on as well, because this could be an indication that what we're seeing here is a correction, but the broader trend is unchanged. So a few levels to keep an eye on here, but what's important is whether we see a break and a close above 75 in the short term. One or two more charts which I just wanted to highlight here. The first one is copper. Now the reason we wanted to highlight copper is because, again, I've highlighted this on a prior video. We had this consolidation throughout the end of the year. Looked a bit like a flag formation, albeit a shallow one, but we have seen a break below here, and now we're trading back around $2 once again. This is a very important support level. It's a big psychological level again. We haven't traded at these levels for a number of years. We're going back all the way back to we're going all the way back to 2009, May 2009, the last time we traded below these levels. If we can see a break below here, I think this is a psychologically significant break, and we could be looking back towards these 190 levels based on what we've seen previously, again back in 2009. This when we previously traded, below these $2 levels. The next major level here we're looking at was this prior resistance again, October, November 2005. It was a major resistance, and when it pulled back, it tested it as support again around these 190 levels before breaking through those $2 levels. So I think this could be technically significant again, but again we need to see a close below these to this $2 level, which, given today's Maribozu candle, a very aggressive candle, does appear fairly likely. For more in-depth news and analysis, check out OANDA Market Pulse at MarketPulse.com. You can also find out more about OANDA and sign up for a free demo account at OANDA.com. Here you'll also get access to OANDA Forex Labs, which has a lot of great tools designed to help you in your trading.